You know, we always say that trading is as much a mental game as it is about the numbers. So today we're doing a deep dive into a cognitive bias that can really mess with your head, even if you got tons of experience. Recency bias. Have you ever had that feeling of being totally invincible after like a hot winning streak? Or like on the flip side, you have a couple of losses and suddenly you think your entire strategy is garbage. That's recency bias messing with you.
That's exactly what it is.
And it can totally sabotage your trading.
It can lead to a lot of costly mistakes.
So basically, our brains love taking shortcuts. And it sounds like in trading, those mental shortcuts can be pretty dangerous.
They can, because what happens is you kind of forget about the long game and you get like hyper-focused on what just happened. Even in the grand scheme of things, it's just a little blip.
Right. Okay, so our brains are kind of playing tricks on us. But I'm curious, how does that actually play out in the markets? I mean, isn't the market supposed to be like this perfectly rational machine where prices reflect like all the available information?
Yeah, I wish it were that simple.
Yeah.
But you have to remember that the market's made up of people.
Right.
And people, we aren't always rational, especially when it comes to money.
Yeah. Especially when our own money's on the line.
And emotions, things like fear and greed, they can really cloud our judgment. And those emotions, they're often like totally amplified by recent events.
Okay, so even though we know logically, like the market has ups and downs, our emotions get kind of hijacked by like those recent wins or losses.
Right.
And then we're making decisions based on feelings and not logic.
Yeah, exactly. And I think one of the biggest dangers of recency bias is that it can lead us to just completely abandon a strategy that's actually totally sound just because of a few bad trades.
I feel like we've all been there at some point, right?
Yeah.
Where you finally find a strategy that seems to work, you've back tested it, you're feeling good, and then bam, a couple losses in a row, and you just start doubting everything. And then that's when you're like most vulnerable to making like an impulsive decision that you'll regret.
Exactly. Like maybe you start tweaking your strategy too soon,
Right.
or even worse, you just ditch it completely and jump onto whatever the next hot trend is, which usually just leads to chasing losses.
Oh, so like our brains are basically telling us avoid pain,
Yeah.
seek pleasure in the short term,
Right.
even if it means sacrificing those long-term gains.
Exactly. It's that instant gratification monkey that we all have on our shoulder,
Yeah.
always looking for that quick win,
Yeah.
even if it means putting your overall goals at risk.
So how do we fight back against this? I mean, how do we train our brains to just stay focused on the long game?
That's the key. It's all about building up that mental discipline and really putting systems in place that protect us from ourselves.
Yeah.
And one of the most powerful tools you have is a really well-defined trading plan
Okay.
with clear entry and exit points, risk management rules, and importantly, a process for reviewing your performance.
Okay, so basically like taking the emotion out of the equation as much as possible.
Exactly. Think of your trading plan as your shield against that recency bias. When you have a plan and you stick to it, you're less likely to get swayed by those wins or losses
Right.
because you're making decisions based on logic and data, not how you're feeling at that moment.
So it's like having this set of rules that govern your trading,
Right.
no matter what the market's doing
Yeah,
or how you're feeling that day.
exactly.
Right, okay.
And then another important strategy is diversification.
Okay.
Just don't put all your eggs in one basket. One part of your portfolio is having a rough time, other areas can kind of stabilize things.
And that way, you're less likely to just make a rash decision based on the performance of like a single asset.
It's like having shock absorbers for your portfolio.
Exactly.
Nice. Okay, so we've got to have a plan and diversify. What else?
Well, another really important piece of this puzzle is understanding the difference between cognitive biases and emotional biases.
Okay.
Cognitive biases are like those mental shortcuts our brains take to process information quickly. They're not bad in themselves,
Okay.
but they can lead us astray if we're not paying attention.
Okay, so it's like our brains are trying to be efficient, but sometimes those shortcuts take us down the wrong path. Okay, so what about those emotional biases? They sound even trickier.
They can be.
They can make us sell way too early when we're afraid of losing money, or hold on way too long when we're greedy for more profit.
And I'm guessing that recency bias, that just like amplifies all of those emotional biases, right?
Oh, absolutely.
Like when you're riding high after a win, you get greedy and you take on way more risk than you should.
Right.
You get scared to make like an impulsive decision just to try to get back to even.
Recent events, they have a way of distorting how we see risk and reward.
Mm.
It's like our brains are hardwired to like prioritize those immediate threats and rewards, which, would be helpful in like a survival situation. In trading, it can be disastrous.
Yeah, totally. So how do we counteract those emotional biases? Is it even possible to control your emotions when there's real money on the line?
It's not easy, but it's essential if you want to be a successful trader. And one of the most powerful tools I think you have for managing your emotions is journaling.
How does writing in a journal help with trading?
It's all about building self-awareness. When you journal about your trades, you're forcing yourself to slow down and reflect on your decision-making process, and you start to see like patterns emerge. Like maybe you tend to make riskier trades after a big win.
Right.
Or maybe you exit trades too early after a losing streak. By recognizing those patterns, you can start to develop strategies for like managing your emotions and making more rational decisions.
That makes a lot of sense. It's
Yeah.
like shining a light on those subconscious biases that are driving our behavior so we can start to make conscious choices instead.
Exactly.
So journaling is a big one. What else can we add to our recency bias toolkit?
Another powerful technique is visualization.
Okay.
Before you enter a trade, visualize both the potential upside and the potential downside.
Oh, okay.
Imagine yourself staying calm and sticking to your plan, even if the trade goes against you.
So it's kind of like mental rehearsal, like athletes visualizing themselves making the winning shot before the game.
Exactly.
Yeah.
The more you can train your mind to handle those like stressful situations, the better equipped you'll be to make rational decisions when the pressure's on.
I like that. It's like building mental resilience, a kind of emotional armor that protects us from the inevitable ups and downs of the market. So we've talked about journaling, visualization, having a solid trading plan, diversification. Anything else we can do to keep that recency bias gremlin at bay?
One thing that can be really helpful is seeking out different perspectives.
Okay.
Talk to other traders, read articles, listen to podcasts.
Yeah.
But don't just surround yourself with people who agree with you all the time.
Right.
Look for people who challenge your assumptions and make you think about things in new ways.
That's a great point. It's easy to get stuck in an echo chamber, but hearing different viewpoints can help us break free from those narrow perspectives and see the market more objectively.
Right. And it's not just about other traders.
Okay.
Pay attention to what's happening in the broader market and in the world around you. The more aware we are of the bigger picture, the less likely we are to get caught up in the short-term noise.
So it's about broadening our perspective, both in terms of who we listen to and what information we pay attention to. It's like taking a step back from the trees to see the whole forest. But I'm curious, we focused on how recency bias impacts us as individual traders, but how might it be affecting the market as a whole? If everyone is susceptible to this bias, could it be creating larger market trends and distortions?
That's a great question. And the answer is absolutely yes. Recency bias can create a sort of herd mentality in the market,
Right.
where everyone starts following the latest trend without really thinking about the underlying fundamental.
So it's like a self-fulfilling prophecy. The more people react to recent events, the more those events become amplified, creating these exaggerated market swings.
Exactly. If enough people believe that a particular asset is going up because it's been going up recently, they'll keep buying it,
Right.
driving the price up even further, creating a bubble. And the same thing can happen on the downside. If everyone starts selling because of recent losses, it can trigger a panic that sends the market crashing down.
So how do we avoid getting caught up in those market-wide swings driven by recency bias? It seems like it would be pretty hard to stay rational when everyone else is losing their minds.
It definitely takes discipline, but one of the best things you can do is focus on your own research and analysis.
Okay?
Don't just follow the crowd. Do your own due diligence. Understand the fundamentals of the assets you're trading.
So it's about having the confidence to go against the grain sometimes, even when everyone else seems to be heading in the opposite direction.
Exactly. It's not easy, but that's where the real opportunities lie. The market tends to overreact to both good news and bad news.
Okay.
So if you can stay calm and rational when everyone else is panicking,
Right.
you can often find great buying opportunities. And conversely, if you can resist getting caught up in the euphoria when everyone else is buying,
Yeah.
you can avoid getting caught in bubbles.
So it's about being a contrarian, but not just for the sake of being different. It's about having the conviction to stick to your own analysis, even when it goes against the prevailing sentiment.
Right. And that's where experience comes in. The more time you spend in the market,
Yeah.
the more you see these patterns repeat themselves.
Mm.
You start to recognize those moments when the market is getting carried away by emotions,
Mm.
and you can adjust your strategy accordingly.
So experience is like a vaccine against recency bias.
In a way, yes. The longer you stick with a well-researched strategy, the more immune you become to the emotional roller coaster of recent wins and losses.
Right.
You develop a deeper understanding of the inherent volatility of the markets and the importance of staying the course.
That's encouraging for those of us who are still building that experience. Knowing that it gets easier to manage those emotional swings over time is definitely a motivator to stay disciplined.
Absolutely. Every trade, every market fluctuation, every lesson learned is adding to your experience bank.
Hmm.
And that experience is invaluable in helping you make rational, objective decisions, even when the market throws a curveball your way.
This has been incredible. I feel like we've covered so much ground today. Any final words of wisdom for our listeners before we wrap up?
I'd say the most important takeaway is this: you are more than your last trade. Don't let the euphoria of a recent win or the sting of a recent loss dictate your actions. Stick to your strategy, stay disciplined, and remember that trading is a marathon, not a sprint.
Yeah, I love that. It's like we're building up that mental resilience, that emotional armor that protects us from the ups and downs of the market.
Exactly. Knowledge is power.
Absolutely. Well, this has been a really incredible deep dive into the world of recency bias and how it impacts trading. Thank you for joining us on this adventure. And remember, risk happens fast, think different.